This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 27th. Some highlights from today's show. Record high stock prices, the gold is now in correction mode, and US PCE data is now in focus. A good day, traders, and welcome. Happy Friday to all of you. Let's get stuck straight into it. So there's not a great deal going on again in the overnight session. Quite a lot of what we've seen, of course, over the course of the week. We do, of course, see Europe sort of taking over the rally that we saw in the US yesterday and following through. So DAX up 0.5%, CAC up 1.25. Now, this shouldn't necessarily come as a surprise. I think the key takeaway, particularly from Europe over this week and last week, is the underperformance that's going on in Europe. I think that's something that is very, very prominent. It's something we need to be switched on for. It matters because we know for most of this year, Europe has massively outperformed the US, and that suddenly just switched this month where Europe is now very much lagging the United States. So something interesting there. What does it mean? Well, it just means it's lagging. Nothing more than that. Now, if we look across at some of the currencies, again, it's this continued theme of dollar sell. We, of course, have seen that over the entire week where it's literally just been one-way traffic for the dollar. And we'll talk a bit about that in a minute because I think it does matter. It is, of course, one of the big one of the big trades this year. It's one of the most crowded trades as well. So we do just need to be switched on for that and what could shift that. And then looking at the bonds, it's pretty muted. We've seen a little bit of a downside, but don't forget we do, of course, have the month-end rebalancing, which starts today. Now, with that in mind, let's get stuck in and talk a little bit about that first topic, which is this idea of ultimately a dovish Fed. Now, this isn't new. It's not new news. You can go and read through this. But it's just this general idea that, at any moment, at some point, Trump is going to be announcing his pick. Now, the reality of the situation is not that it's necessarily market moving, but what it does mean is that whoever comes in place is going to be a hell of a lot more dovish than Powell, and he's probably going to bring cuts or front run rate cuts. In other words, the general consensus of the Fed as of the dot plot that we got, just over a week ago, was this idea of 3 cuts between now and the end of next year. Okay, 3-4 cuts. Now, again, I say it very loosely because, of course, it is a median dot projection based on a number of different things. But think of it as 3 to 4 cuts between now and the end of next year. Now, the reality is we know that President Trump has been banging on about this idea of, look, we should be at least 1%, 2% lower. Okay, so the point is whoever comes in place is going to cut a hell of a lot more than what the market's pricing, which is 3 to 4 cuts. Okay, the point is whoever comes in place, you're probably thinking 6 to 8 cuts, somewhere around there, and back to perhaps neutral, even slightly below neutral in a very short space of time. And that's what the market's thinking, and that's why the dollar is a one-way bet right now, because the reality is that Trump is not going to pick someone hawkish. He's going to be picking someone that's going to cut rates aggressively. So why wouldn't you be short of dollars? Now, it's not to say that trade is going to keep on giving. We do know that, of course, the dollar is down. The index, the dollar index itself is down 12% this year, which is quite a significant move. Now, sure, it does have further downside to go, and sure, there will be some bounces, and I think that's the key message to take away from this, which is you've got to be looking to buy the strong currencies, and I'll show you which are those currencies in a moment when we get onto the chart. Now, one thing to point out, and I think this is the key takeaway from this article, is right down here at the bottom. The Wall Street Journal reported on Wednesday that the general thinking is that President Trump is going to make his pick around September, October, so roughly 6 months before ultimately Powell is due to step down. Now, this timing of this, I think, matters because this is going to be announced typically after the Jackson Hole, which comes in August. Okay, now Jackson Hole has been very well known, particularly last year and in subsequent years, to be a time when a Fed can set policy for the back half of the year. So should inflation not come out very hot, should it not be surprising to the upside in the next 2 prints, don't be surprised to see Chairman Powell open the door to not perhaps just one cut, but perhaps even more aggressive rate cuts over the
Federally managed land could also be offered.
a month. So just keep an eye on that. I think Jackson Hole is going to be important. Should we get more of the same? Should we get more reluctance from the Fed, more wait and see? Of course, Trump will want to make that announcement as soon as possible so that he can just put some more pressure on the chairman. Now, it doesn't mean having a shadow Fed is going to change anything. They're not going to suddenly aggressively start cutting, but it's this idea of the total number of cuts between now and the end of the year. Remember, that's what the market prices things on. It's not about what comes in September or October. It's about how many cuts can we expect over the next 18 months. And what does the degree of cuts look like? Now, why does this matter? Well, because look, if the market thinks 4 cuts is the general consensus and whoever comes next is going to do 7, okay, the reality is that equity prices will love that. They need to price in that discount rate. So that's very positive for stock markets. That's very bad for the dollar. And of course, that will have an impact on a number of other markets. And I think that's the key takeaway. And that's also why this week, I think very important, if you go look at the bonds in particular this week, it's why we've actually started to finally see a little bit of movement in the bonds across the entire curve. 2-year, 10-year, 30-year, all of them, we've seen a bit of compression in yields this week, which is a first. It's the first time we've seen a little bit of movement in the bond yields for some time. So don't be surprised to see that trend start to pick up a little bit of speed over the course of the next couple of days and weeks. Okay, now to follow on with that, I think there's another article that talks about the consensus trades on Wall Street. And I think this is important to know. It's always good to know where the weight of the market's at, what's everyone betting on, because it does look as though we've kind of gotten to this point where it's all clear. It's sort of one-way bets. It's, there is no risk. It's this idea of just buy equities and be long of gold and be short of dollar and you are guaranteed to make money. Now, whenever markets get to these sort of very one-sided bets, you've always got to be switched on, because if something was to come out that comes counter to those one-way bets, okay, there's a lot of liquidation that needs to take place. Now, of course, it's not to say you just go against the consensus, you're going to make money, but it's to know if there is a catalyst. For example, if President Trump came out today and he said, look, we're going to put a 20% tariff on the EU because they're not playing ball, well, the reality is, taco trades aside, the reality is there are a number of positions that will come unstuck, okay? And that's why we want to be switched on for it, just to make sure if there are catalysts that come against those consensus positions, we can take full advantage of it. Now, those 3 trades, of course, like I said, are long gold. That's been a trade now for the last 2 years, and we're starting to see that come unstuck. We'll talk a little bit about gold in a minute. I do think gold's got quite a bit of downside. And the reason is because obviously the main thesis behind gold over the last 2 years has been as an inflation hedge. Okay, and the reality is we keep seeing inflation ticking down, keep missing the consensus numbers. So should we of course see misses in the subsequent in the months coming up now in June and July, we will of course get further downside in gold. So that's one to talk about. The other of course is the Mag 7, and we'll talk about that chart in a minute as well. We know that has been a favorite. We can see the likes in NVIDIA back up at record highs, and then of course short US dollar. Okay, of the 3 of them, I think the bet that's perhaps the safest is the short US dollar, simply because, like I said, the President of the United States wants lower rates. He doesn't want 3 cuts. He wants a hell of a lot more than that. Okay, so that is the one bet that I think is quite safe. But again, it's not to say that it cannot come unstuck. If suddenly we got a massive beat to the upside on the inflation print in 2 weeks' time, okay, that bet's going to come unstuck. We are going to see quite a liquidation in that market, simply because everyone is short of the dollar. Okay, and that's why we want to know these bets. Now, very important, we do know that Morgan Stanley has come out. They're one of the few banks that's actually talking about this idea of very, very aggressive rate cuts. They're talking around 175 basis points of cuts between now and the end of next year. Okay, now to put that into perspective, that's effectively if you go 7 rate cuts between, to get to 175 basis points. What that means is effectively the Fed starts cutting in September. They will effectively cut 3 times this year, and then obviously 4 times at the start of next year. Okay, quite a lot of rate cuts and quite aggressive relative to what everyone else is thinking. Now, very important to stress, what ultimately gets the Fed cutting that aggressively? Well, it's some sort of an air pocket, whether it's an air pocket in the employment data or whether perhaps inflation is a little bit softer than expected. The important thing to know, and this is key, there's 2 types of cutting cycles. You can have a gradual cutting cycle, which is inflation slowly makes its way back to the Fed's target, and that's very positive for the stock market. Okay, why? Well, because they can slowly cut interest rates, economy's still chugging along quite nicely, inflation's moving back to target. That will be very positive for the stock market rally. If we start to get 25 and 50 basis points cut, ultimately that's because we've hit a growth pocket in terms of growth dynamics. In other words, not necessarily a recession, but perhaps low growth, maybe a small negative growth, some sort of a scenario like that. And that, of course, will mean they will need to get a repricing in some of the equity markets. Okay, so just make sure you know the difference between two rate cut cycles. Gradual, more positive the stock market. Very aggressive means perhaps they are cutting because we are hitting some form of a recessionary type scenario. Okay, now let's get over to those charts because it's important to know where the bang for buck is. This is the dollar index. This is some of the major currencies against the dollar. And the key takeaway from this is in the white and the orange, we can see the two prime candidates. It's the euro and it's the Swiss. And this should come as no surprise. It's the divergence play. Come out of the United States, it's expensive. Move into Europe, it's relatively cheap. Its stock market's relatively cheap, albeit relatively small as well. The point is they've been the star outperformers this year. Okay, the Swiss franc is up 13.5%, and the euro is up just shy of that. Okay, so those are the two prime candidates. Those are the two places that, over the next 12 to 18 months, you're probably going to see further upside in the euro, in the Swiss. Okay, now not far behind that, we've got the pound. We can see that's up just shy of 10%, as well as, of course, the yen is up 8.5%. So again, two good candidates to trade. They are going to perform well against the dollar over the next 12 to 18 months. But like I said, it's always about buying strength. And of course, you can trade the laggers, but you need something currency that has its own set of fundamentals. Okay, the key takeaway is everything is up. Now, one thing I want to stress, okay, we're talking about the dollar being a very crowded trade. What is something that could change the dynamic? Now, to understand that, we actually can look at what ultimately created the only pullback this year in the currency space. Okay, so if we start off around April where this line is, that's when we had Liberation Day tariffs. Okay, and you can see at that point, markets, dollar was a little bit down on the year, but mostly speaking, it was relatively nothing going on. It was all of a sudden when we had those Liberation Day tariffs that we, of course, saw Swiss franc, euro, and the Japanese yen all rally very, very aggressively. Okay, we of course did also see the same thing for the likes of some of the other currencies, but that's predominantly where the safe haven money went into. Right? At the same time, of course, we can see the emerging markets collapse. That makes absolute sense. Risk off. You don't want to be holding emerging market currencies. But the key takeaway here is we did have a correction. Okay, there was quite a correction in all of those safe haven assets, euro, Swiss, and yen. And it came when? Well, it came when, of course, we got the 90-day extension. Okay, and this is the key thing I want to stress is we're about to find out from the White House about what comes next in terms of the tariff situation. The general thinking is it's going to be 10% plus across the board. That's the general thinking. So if that is the case, if they do impose 10% plus, right, don't be surprised to see, of course, some of these currencies hold on to these gains. But if all of a sudden it's another, well, look, we're going to extend it by another 90 days, or perhaps more countries start getting just 10%. Don't be surprised to see, of course, again, just a little bit of a rebound in the dollar. It doesn't shift the thesis, but what it does mean is we might see a little bit of profit taking come in the likes of Swiss, euro, and of course Japanese yen. Okay, and that's the key takeaway here. It's not that the dollar short trade is not alive and well. It's going to remain alive and well because, like I said, the thesis is the Fed's going to have to cut a hell of a lot more, and that's what the market's trying to price in now. Now, in terms of the stock market, in terms of the equities, okay, the consensus or the big trade here is everyone is effectively long Mag 7 because the Mag 7 can do no wrong. Earnings expectations are being revised up, and we do, of course, have the earnings release is starting at the middle of July. So, again, we're going to find out a lot about the Mag 7, but the key takeaway is that we can, of course, see how the Nasdaq is very much the one that's leading to the upside. Okay, it's all been tech-driven. We can see that for the most part of the rebound, the Nasdaq and the S&P were pretty much moving in tandem. But all of a sudden, since the start of June, we can see the gap between what the Nasdaq's doing and the S&P doing starting to widen. Moreover, we can see that the Russell itself is very much lagging. Okay, the Russell has just gotten back ultimately to those Liberation Day tariffs because it's far more closely linked to the US economy. Okay, in other words, a large part of the consensus right now is buy tech, stay long the AAA rated, can do no wrong, cash cows of Mag 7, and that is pretty much where the weight of the market's sitting. Everyone's sitting in Mag 7, and so should that come unstuck, what can make that come unstuck? Well, of course, a hawkish Fed, perhaps a Fed that doesn't cut this year, that will have an impact, of course, on some of the earnings of the Mag 7. So just be switched on for that. Okay, and then finally, in terms of gold, we know that has been a favorite for the markets now for 2 years. I spoke a lot about this last year, that the key driver, of course, of gold was very much when the Fed flipped its priority away from inflation to the labor market. Okay, we also saw gold very much start the second part of its rally in September. That's that point there. Why? Well, because Chairman Powell decided to cut 50 despite inflation being well above target around that 3% mark. Okay. Now the key takeaway is that gold has effectively had a little bit of a triple top. Okay, like I said, the consensus is for gold to go a lot higher this year, to make a record at some point this year. The thesis remains intact. We still have high inflation, but we're starting to see this idea of disinflation creep in. And I suspect that's why we're seeing a little bit of weakness come into the gold market. And this weakness is not just in gold. It's gold relative to the likes of platinum, gold relative to the likes of silver. Okay, and that started 3-4 weeks ago. 3-4 weeks ago, we started to see gold underperform, and that is very, very unusual behavior. And it's simply because we have started to see a miss in a lot of the inflation prints. Okay, so don't forget, a large part of this thesis was driven by higher than expected inflation. It was driven, of course, also by the weak dollar scenario. Okay, now the key takeaway, what I want to show you on this chart and why I've got this up, is that I suspect this correction is going to be very, very similar to what we had back in November last year. And I remember it because I bought this very early on and I had to sit quite a long way offside. Now, what I want to show you is ultimately how when we crossed below the 50-day moving average, we actually had quite an aggressive sell-off. Okay, this was roughly speaking a 10%, well, 8.5% correction that started in November last year. And we very much crossed over that 50-day moving average. As of today, we're probably going to close below it. So I do expect a little bit more downside, perhaps all the way down to that 31.80. So what that does mean is we're going to get a nice healthy correction in gold now. And what that does mean is you don't want to be buying this too soon. Okay, it's very much a market now that I suspect it's hit a little bit of an air pocket, and it's probably going to give up a little bit of the gains that we have seen over the first sort of half of this year. Now, key to what makes me confident of further downside, well, look across the screen. Platinum's down 5% today, silver's down 1.8, and they've been the leaders for the last 2-3 weeks. When the leaders are starting to sell off, well, guess what? The laggers are very much going to sell off as well. So keep a close eye on that. I do think there's some really good downside opportunities in the gold market. Now, we do have PCE data today. It is the Fed's preferred gauge. It is going to be very closely watched. Like I said, the last 2 inflation numbers from the US have missed against the consensus. Don't be surprised to see this miss as well today. The year-over-year expectations for 2.6%. Should we see a repeat of last month at 2.5? Again, music to the ears of the equity markets. They're going to absolutely love that idea. We will, of course, see the dollar continue that sort of trend we've had all week, which is to continue sell off. Okay, so keep a close on that PC. Should we get a miss of something of like 2.4 magnitude, okay, watch out. That is going to create some interesting trades. And like I said, the consensus all week has been sell dollar, long bonds, long equities. You get a miss in this PCE today, those consensus trades for this week continue. They will not stop. They will continue, and we will look likely to close the week on the high for equities, the high for bonds, and of course the low for the dollar. Now, in terms of if we got a beat, what does a beat look like? Well, look, if we come in at a 2.7, even perhaps a 2.8 in the area, that is going to create a bit of head scratching. Okay, obviously we have had quite a big move in the dollar this week, quite a big move in the equities. So 2.7, 2.8 is probably going to force a little bit of profit taking, and so it does make the PCE day to day quite a nice binary event. But of course, the PCE is a bit like watching paint dry. It very seldom misses or beats. But of course, we will be watching it and prepare for it. And then finally, the play of the day. I think it very much comes down to the S&P 500. The reason I've got the profile, the composite profile up here, is just to showcase how stretched we are on the week. Okay, it's a very, very stretched week now. We were trading as of Sunday, Globex session, we were trading just below 6,000. We're trading around 6,220. Now, that in its own is not necessarily a reason to be short, but it is a very expansive range week. It's a breakout week, but it is a week that perhaps we are now going to see a little bit more consolidation. Okay. Now, what I do like about how this is structuring itself is that we've kind of created a bit of a breakout low volume area at the high of the week, and that's very unusual. It does tell me that perhaps some of these longs are quite vulnerable, and we will get a little bit of a snapback at some point today. So I would expect 6200 to trade again today, 6190 to trade again today, and just to sort of maybe fill out the top end of that range. Of course, we do have data to contend with, but how I do expect this market to trade out, we've got record highs coming in around 62.30 on the futures. Keep an eye on that. Okay, it'll be very, very unusual for us to stage a very aggressive breakout today. We test that 62.30 record high prices. Don't be surprised to see some profit taking. Okay, so that is the play that I think a retest the record highs. You can probably nick 20 points out of that. Likewise, you can probably buy it at 61.90 and make 20 points out of it. 20 points either way. 20 plus 20 makes 40 points. Should be a pretty good day to finish the week. Okay, with that in mind then, of course, let's wrap up and talk just a little bit about the expectations. It has been an interesting week. It started off volatile and it ended pretty much dead quiet. And that's not going to change today. It's going to be more of that as we move into July 4th next week. So just factor that into your weekend analysis. Otherwise, if there are any other questions, do post them in the Discord channel. Thank you for joining me this week, and good luck out there. Manage the risk. Go make some money.